Hello everybody and welcome to this edition of Hardman Talks. My name is Keith Hiscock. I'm the CEO of Hardman Co. And I'm pleased to be joined today by Richard Stone, who is the CEO of the Association of Investment Companies. Now, the AIC is the trade body for quoted investment companies in London, and Richard joined as CEO nearly 18 months ago, so he's got a really fresh set of eyes to look at the space. Now, investment companies are increasingly attractive, I think, to retail investors who run their own money, being collective funds and a good way of getting diversification. But there are, I think, some questions that investors have. So the first one, Richard, is that I think some people would think of investment companies as sort of slightly old-fashioned. So why should investors consider them today?
Morning, Keith. Thank you for that. Yes, we've been around as a sector for over 150 years, so you can understand with that history that they might seem to be slightly old-fashioned, but actually throughout their history, they've offered investors access to the frontier markets of the day. So you go back 150 years ago, that was income-paying bonds on foreign markets that investors couldn't get access to. Today, it's space technology and renewable energy infrastructure and all of those sorts of things. So they have moved with the times, one might say, and adapted so that they can continue to offer investors access to those kind of asset classes that they might not be able to get access to elsewhere. And the fundamental structure has significant benefits for investors, and really that's what's seen the sector through and enabled it to go from strength to strength, really. It's now bigger than its US equivalent. There's no other sort of closed-ended listed fund sector in any other market in the world of any note. So yeah, it's a real UK success story in that sense.
Oh, so you've touched on some of the asset classes that investors, sometimes even institutional investors, find it difficult to get access to, that you can buy into through the investment company route. Do you want to just talk about some of those different types of funds?
Yeah, so I think investment companies, because they're a permanent pool of capital, you're trading the shares rather than creating new units or redeeming units. It means the investment manager can take that longer term view, and they can invest both in smaller cap stocks, but they can invest in illiquid stocks and illiquid businesses as well, so private equity, private capital. And so the investment company for investors who are looking to access those less liquid assets, the investment company structure is the ideal vehicle to do that, because the investment manager isn't under pressure. You haven't got a liquidity mismatch between the structure and the underlying assets. So, for example, if you take the renewable energy infrastructure sector, we've now got 22 member companies in that sector. They're all new within the last sort of 10 years. They've raised, or they managed today, about £18 billion worth of capital. And actually, in terms of their ownership, in terms of who owns the shares in those companies, it's about 70-75% of that's owned by institutional investors. So as you say, institutions are using it as a way to access those asset classes that they can't get elsewhere as well. Whereas overall, the sector's owned about 50-50 between retail and institutional today.
So you touched there on the fact that these are companies with share prices that move. And so one of the big differences between investment companies, closed-end funds as they're also called, and open-ended funds, or people might know them as OICs or unit trusts, is the fact that the share price isn't necessarily the same as the net asset value, and it could trade at a discount or indeed a premium to that. Why is that a good thing for investors?
Yeah, I mean, an investment company, as I said, that you trade their shares rather than creating and redeeming units. So those shares trade at a market price, and effectively that's the trade-off for liquidity. So you have liquidity, but that's at a market price that somebody else is willing to pay you for those shares. So they get driven by both the fundamentals in the underlying portfolio, but also by market sentiment and market views of the assets and their potential futures. I mean, clearly, if an investment company is trading at a discount, it's potentially an opportunity to buy assets at below their net asset value, and some investors will see that as an opportunity. I think it's worth just noting a word of caution relative to investment companies that are invested in other listed companies and therefore are doing a daily valuation, and you can see the nature of that discount. with the more illiquid assets that the sector has moved more heavily into in recent years, the net asset values might not be produced as frequently, and the discount therefore perhaps is reflective of market sentiment, but investors just need to be a little bit careful on the discount side. But yeah, discounts can provide an opportunity for investors to come in at below net asset value. Premiums, reflect the fact that the market thinks that there's significant future value in the underlying portfolio. So, I wouldn't necessarily be put off in either direction. But as an investor, you have to remember you're trading a market price with another investor in a share, as you would trade a share in BP or Marks and Spencers or something, rather than trading at net asset value.
And the problem of always not having a share like any other company, I guess maybe I can say this and you can't say this, but in the unit trust world, you sometimes get the problem, for example, in property funds, that there's no cash around, and if a substantial seller comes in, they can't trade.
Well, as I said,
they might get suspended effectively.
Yeah, as I said, the market price, the fact that there is a market price and you're trading at the market price with another investor who's prepared to buy those shares from you at that price, the differential to the net asset value to some extent is the trade-off for that liquidity. So, as you say, if you look at the property sector, where you have an open-ended fund invested in illiquid assets, if the asset manager is faced with a raft of redemptions, unless they have the liquidity in the underlying portfolio, they may not be able to meet those redemptions, and ultimately you may see those funds suspended. You rarely see that in the closed-ended world, because the asset manager is not under the pressure to redeem the assets in order to meet the sale demand effectively. The sale demand is met by other people willing to buy those assets in the market. So the asset manager doesn't have that liquidity mismatch to deal with. And as I say, that's effectively the trade-off relative to the open-ended sector, but it's giving you access to asset classes that you wouldn't necessarily otherwise be able to access.
Having said that, though, some investment companies have policies that in the event that a large discount grows, they've got various techniques to try and close that discount. Can you describe what those broadly what those sort of techniques are?
They do, and the most common or classic technique is the share buyback. So the company has the ability to go into the market and effectively buy back its own shares. I mean, if you think about a share price as being a function of supply and demand, ultimately, if the share price has fallen, you can increase the share price theoretically by increasing demand for the shares. And so the company coming into the market to buy its own stock is effectively a way of boosting demand and getting back to the point where you can hopefully close that discount. Clearly, you need some liquidity in the underlying portfolio to do that. So you will typically see share buyback policies, or you're more likely to see those in the sort of equities type mandates where there is some liquidity in the underlying portfolio. There are other techniques. Companies perhaps have redemption windows where you can ask to redeem at NAV or par. You sometimes get continuation votes where the company will effectively ask the shareholders regularly, periodically, if they want to continue or whether they want to wind the company up, realize the assets and return the cash. Those sorts of things can act as pressures to try and maintain a share price around the NAV and close any discount. As I say, fundamentally, it's a function of supply and demand, and you'll see investment companies marketing and advertising themselves and telling their story out to investors. That's all part of that process.
That's very interesting, Richard. So not only can we get access to some interesting assets and different assets through the investment company route, but we can also buy assets at discounts to their NAV at times. And for the retail investor out there, I think you've done quite a lot of work since you joined on the website of the AIC. Could you just refresh us on what resources are available there for investors?
Yeah, so the AIC represents the sector as a whole, and on our website, which is theaic.co.uk, you can find a wealth of tools and resource to research investment companies. There are what we describe as a screener tool, there's a compare tool, there's a watch list tool, There's an income builder tool. The ability of investment companies to withhold some income and smooth dividends is another key feature of the structure. And so you can build a portfolio and see when your income will be paid. There's a range of those tools. And beyond that, we have a company profile page for every investment company, so that you can see on there all the details, documents, and everything else related to that specific company. So if you are looking to research a particular company or find a company with a particular characteristic, a certain yield or whatever, then you can do that through the website. And I'd encourage you to go that. We also carry all the research on those companies as well for investors. So it's a real go-to place. As I said, the aic.co.uk, I'd encourage any investor interested in investment companies to go and have a look.
Richard, thank you very much for those words and explanation. And thank you for joining us. And thank you also to our audience for joining us. Please like and subscribe to our YouTube channel, and we look forward to seeing you on our next Hardman Talks. Thank you very much.